Welcome everyone. Thank you so much for joining us today for the Home Buyers Seminar. My name is Nicole Lopez, and I'm with Royal LePage Terra Equity Realty Brokerage. And I just wanted to welcome you all here today. And I want to also introduce you to my special guest, Lauren Andrews. Lauren Andrews is a mortgage broker. He's a principal broker for Dominion Lending Center's Expert Financial. He has been in the real estate industry for over 26 years. He has been a real estate agent, a broker of record, managing and other real estate agents. He has taught at the Ontario Real Estate Association. So he's also been an instructor for teaching people real estate. And now he is on the financial and the lending end of the real estate business. So I just wanted to welcome Lauren here. He has a wealth of knowledge and is awesome to work with.
Thank you, Nicole.
All right, so just wanted to get on to the agenda for today. We'll provide you with a little bit of a market update. And with that, we'll talk about when's the right time to buy. I can really answer that question now. The right time to buy is technically when you are ready, when you feel comfortable, you're ready, you have the appropriate down payment, you find a property that you would like to purchase. That's the right time to buy. So there's no crystal balls, there's no timing the market, but there's information that you can understand and learn about in terms of the market update. I have Lauren here, and he's going to give us a really excellent overview of the financial aspect of making your purchase. So financing your purchase, and also there is a new program that is currently available to help with down payment assistance. So the down payment assistance program is not only for first-time buyers, but any home buyer. So this is a really key element of the seminar today. And then we'll go through the home buying process, just high-level items, and then preparing for your purchase. And we'll open it up for any questions that you may have. And also, don't feel that you need to hold your questions to the end. Feel free to enter them in chat or unmute yourself, raise your hand, and we will get to your question. All right. With that, we'll get right into it with what's happening in the market. So recent news has a lot of things, saying a lot of things. With regards to pre-construction, many of those pre-construction projects may not be closing, or individuals who bought maybe years ago and now are coming to close because of interest rates. They are maybe having some financial difficulties with coming up with the funds for closing the property. There are also situations where people who are currently in a home and they're coming up to renew their mortgage, they may have purchased their home when the interest rates were extremely low, 1%, etc. And now in the next year or so, they may be faced with having interest rates much higher than when they originally purchased their home. So there are some critical situations happening there. And of course, as everybody's aware, there's a lot happening with the economy. As you've seen over the past several months, interest rates have risen. Most recently, we did have a pause here at the Bank of Canada, but Lauren will speak to that a little bit later. So what does that mean? So for people who are currently in a home at this moment, they're potentially facing an increase in their interest rate for their mortgage renewal. It might be a time for them to think about really reducing the expenses as much as possible to ensure that they are prepared and ready for a moment when that situation occurs, when the interest rate for their mortgage renewal comes up. And it's not little things like, coffee, it's bigger things. Do you really need to spend on big purchases? Can you hold off on something so you can be able to afford your mortgage payments? And then other expenses. Do you really need that new car? Are you able to, have repair and use your current car? On the flip side, there may be individuals who haven't purchased a home as yet, or who are investors. Maybe this is the opportunity for you to save as much as possible, or maybe use your savings to potentially purchase a home. In the sense that interest rates potentially are higher now, or they are higher now. However, over the past several months, the prices of home have been lower. So you would be purchasing a home and maybe a lower rate with a high interest rate, knowing that in the next year or a couple of years, when the mortgage renews, more than likely, based on historical trends, that interest rate that you would renew at would be lower. So those are things or opportunities that you could potentially look at as a homeowner, or even potentially as an investor. Okay, so with that, just to give you a little bit of basics in terms of the housing market. Basically, the housing market year over year typically grows at about a 6.6 to 7% rate. So I'm quoting 6.6 because that's in the region of Peel or the Greater Toronto area. That's the trend that we see year over year, the equity growth for somebody who owns a home. However, that's just like the straight line trend. As you can see here, that trend is not linear. It goes up and down. There's points where it's higher and then areas where it dips. And this all depends on several factors. It could be shifts in the demographics. It could be related to immigration trends, as we've been seeing, and I'll speak to a little bit later. And also in terms of economic cycles, as we now are experiencing the high inflationary rates, potentially maybe moving into a soft recession. So these are some of the key factors that really influence the market. So just from a basic perspective in terms of the housing market. But one thing is for sure, the housing market does on average grow year over year on average. So I put together this graph for you so you're able to visualize what that year over year growth has looked like over the past 23 plus years. So you can see here from January 2000 over to midpoint here is about January 2023, and the end point here is October. So this is a representation of all housing types. So it's apartments, condos, single family homes, bungalows. This is a representation of all the types of homes over the past 23 years in the region of Peel. And as you can see, there has been a significant rate of growth over this period of time. So a couple of things I wanted to point out in terms of things that have an impact on the real estate growth. One of them, as I mentioned before, economics. So as you can see here, in 2008, we had the financial crisis that had been initiated. And you can see during this time period, there had been a dip in real estate until around the recovery period, or when economists were saying we were in a recovery. Also, there are things like regulatory factors that impact housing. When the Fair Housing Plan came into effect in 2017, you saw that there was a little peak and a slow growth. Then in 2018, when the mortgage stress tests came into effect, so this is another regulatory factor where there was additional test or financial stress tests that buyers needed to pass in order to be able to afford or to purchase a property. You see here how it kind of leveled off the rate of growth with regards to equity in homes. That brings us down to this period in time. And that period of time is the pandemic. So this is a global crisis. So that's another factor that impacts the real estate market. And if you look here at the star that I put here, you'll see here that there was some growth that was happening into 2019. People weren't really noticing as much, but when people started to stay home, they started to think, oh, maybe I need a bigger place. People were saving money. And then you saw this steep rise in people wanting to purchase properties. So there was a huge demand and a low supply. So therefore, there were tons of biddings, and in some cases, there were 50 offers on one property because people really wanted to purchase that property. This point here, this is about October, November of 2020, when there was a hint of a vaccine or a solution to the pandemic. And you can see there's a slight pause, but then again, activity was happening at an even greater pace. As people were more active, they had saved money during this 1.5-year period. And as you can see here, the equity price, or the prices in properties, really went up on all types of properties. And then this takes us into, then there was a little dip as the interest rates started to increase. And this is around the February time period, when February 2023. And then you saw home prices, a little bit more activity, not as much bidding, but still in areas that were highly desirable. You saw more bidding occurring. And then this is when we saw the most recent change in the Bank of Canada, when they started to increase the rates again. So this kind of gives you a big picture in terms of, some of the factors that influence the market dynamics. Another key factor that plays a significant role is the population growth. So during this time period, or especially during the pandemic period, population growth grew significantly, and it grew in the sense that there were a lot of students, international students, that were here in Canada. And because we needed to, fill certain positions, and in order to keep Canada competitive and fill job vacancies, many of those international students received a permanent residence status. And therefore, in a pandemic period, we had over 400,000 people added to our population at that time. In addition, this is one of the key policies that the Canadian government is using, immigration, to assist with growing the economy and ensuring that we are able to keep pace with the needs in terms of the technology sector and the healthcare sector specifically. So why does everybody want to come to Canada? I think I mentioned it. Everybody wants to come and work here. It's ranked #1. Remitly, this is a 2020 ranking, but I double checked again. And in 2023, Canada is still ranking as one of the #1 places to come and work. It has friendly, safe, the economy. Everybody wants to come here. And Forbes published in June of 2023 a survey that was conducted by the Economist Intelligence Unit regarding global livability. And Canada has 3 of the top 10 best cities to live globally. So those are Vancouver, which is ranked #5, Calgary, which is ranked #7, and Toronto, which is ranked #9. So these factors, just think about it. Population. People, we have a huge number of people coming into the area. They need a place to live. They're going to be working here. So this is why there's been such a pressure in terms of finding people wanting to purchase a home, or even from a rental perspective, because not only have the prices of homes been steadily rising, but the cost for renting a property has also risen, and there has been a very low vacancy rate. So it shows you that there's a big pressure demand that's there, and we need the supply in order to achieve that. So I'm just going to touch on one more thing to set Lauren up, and that's just giving you a perspective, a big picture perspective on historical prime mortgage rates since 1935 to today. So as you can see, yes, we might be in the close 7% range, but you know, from the 40s, we were on 5%. In the 80s, you know, we had that huge spike. And then we saw historically low interest rates for the past, say, 20 odd years up until most recently. So just to give you some context, yes, we are experiencing high interest rates. We have additional factors that are at play: immigration, low demand, etc. So with that, I'm going to turn it over to you, Lauren.
Awesome. Very good. Very good. So, one of the big things we wait is for there's a few dates throughout the year, the Bank of Canada has their rate announcements. And we all kind of wait with anticipation to figure out which direction is going to go. And there's a bunch of stats that come out before that. And that's, basically the reason for all these rate increases is obviously because of inflation. Okay. And they're trying to bring inflation down to 2%. Okay. And with that, they're hoping that by raising the interest rates, it's going to slow down the economy. It's going to increase unemployment. It's going to eventually, because of the slowdown of the economy, it should start bringing all the costs that everything that goes around with that down. Okay. Now, I mean, if you've watched the news, there's a whole bunch of controversy in terms of, if you're continuing, even the Bank of Canada spoke out against, everybody's, because the Bank of Canada is a bad person for raising the rates, but they spoke out against the government for not controlling their spending, because the government keeps spending. It's causing a further delay for us to get down to the levels that we need to get down to in order for interest rates to start coming down. Okay. And then the latest stats that came out with the CPI, which is Canadian Price Index, and the cost of things, one of the major costs that have increased are shelter costs. Okay. So shelter costs are rents and mortgage payments. And why have they increased? Well, because the rates have been going up, right? So a lot of the inflationary things are actually caused by the policies that are creating to even prevent, the rates from, they're trying to get the rates to come down. Meanwhile, they're throwing in carbon taxes and everything that's causing the overall, cost of everything to go up as well. So, anyway, but we got to control what we can control. So the good thing about the last report is it looked like there was a definite decrease in CPI, and all those statistics that came out made the Bank of Canada say, okay, well, wait a minute, maybe we're there. Maybe we don't need to increase anymore. And with that is, you have the global economists, Benjamin Tall and everything else that are now saying that, I think the next slide, I have a slide with him. He's saying that, okay, we're very close to the end of monetary tightening, which is good news for, anybody that's getting into the home buying, that potentially the rate increases could potentially be over. Okay. And he's actually gone so far as to say he believes that by the end of the first quarter of 2024, we should start seeing our first set of rate reductions, which would be great news for a lot of people. Okay. So what does this mean? So the thing is that, when we look at financing and financing our purchases, obviously, as Nicole had mentioned earlier, it's getting tougher to qualify for certain amounts because interest rates go up. The government introduced that stress test, Nicole, that you talked about, which is you have to qualify at 2% above whatever those rates are. So it's lowering people's purchasing power. Okay. Now, if we get into, another question you asked, is now a good time to buy? Here's the thing. You mentioned back in 2021, rates were very low, right? Rates were extremely low, but you also said at that time, there was sometimes upwards of 50 offers on a particular home because the inventory it was not matched up with the demand. Okay. And they're saying right now, especially in the GTA, for the first time in I don't know how long, maybe ever, it is now considered a buyer's market because there's so much more inventory than the demand for buyers that are out there that it's now giving buyers choices. Okay. There's lot less competition for every single listing. And when we think of, purchasing a home, you probably, if you're selling a home, you want to sell it at the highest price possible, right? Because you're selling. But if you're buying a home, you want to buy at the lowest price possible because you're buying a home. Now, if you're selling and buying, it doesn't make a difference because you're going to buy high, sell high, and et cetera. But if you're getting into the market, you want to try and it's almost impossible to time the market. And like you said, the best time to buy is when you're ready to buy. But if you're ready to buy and where the market is right now, I would say now is the best time I've seen in many, many, since my 20 years for a buyer to get into the market. And I say that because people say, Lauren, you know what? But freaking interest rates are so high. But the thing is, we got to remember that, we marry the property, but we only date the rate. And the rate will not stay where it is for that much longer. And we know the direction it's going to start coming down is down because they also need to stimulate home ownership. Nicole, you mentioned, all the influx of immigration and everything coming into the country. Everybody's got to have a place to live. And um, there isn't a lot of supply out there relative to the demand. And what's happening, if anybody's renting right now, you've seen what's happening with rents because the inventory for rents is low. All right. So what if there's a way? What if there's ways that we can actually get you into a home sooner than you ever thought? And I think with the very, reason why we're going to go through this is we're going to introduce you to some programs that exist that you might not know existed that could change the way you're thinking about how you could get into a home. So we're going to talk about this. So I've already talked about affordability and everything else. So let's just get to the next slide here. So the question is, so a mortgage broker, what's a mortgage broker, right? So, and why can't I just walk into a bank? You can walk into a bank and they have people there that help you with mortgages. But you have to understand a mortgage broker and what their role is. So a mortgage broker is not connected to any one bank. Okay, so a mortgage broker has access to multiple lenders, maybe 30, 40 different lenders, maybe even more. And the mortgage broker is paid by the lenders when the mortgage is brought to that particular lender. Okay, the compensation for a mortgage broker is based on the mortgage volume, not on the mortgage rate. Okay. So at the end of the day, what happens is all these lenders are competing for your business. So they go out to mortgage brokers and say, here's some rate specials. Here's these, bring your clients to us, right? As mortgage brokers, we're indifferent. So it's basically our role now, or basically what we do is we base our business on the relationships that we have with our clients and understanding what their short-term goals, their long-term goals are, and making sure that whatever lender that we connect with is consistent with those goals. Okay. Because if I walk into the green bank or the red bank or the blue bank, they're only going to talk about everything that they have, what's inside their four walls, And if it's not really a match, because not every mortgage is the same, but if it's not really a match for your individual needs, or potentially, I've had people walk into a bank and say, I couldn't qualify. They've been sent to me as a mortgage broker, and I looked at, how they tried to qualify them, and then they ended up being qualified for a lot more than when they walked into the bank. Um, because again, they have certain ways of doing things. People at the bank are not basically are not really licensed, right? So basically, as a mortgage broker, we have to go through all these courses, licensing, and everything else. Whereas at the bank, you could have somebody that, a teller just got promoted. Now they're in, doing mortgages and stuff like that. And I've had instances where, I've had files declined at the bank, and they've come to me, and I've looked at it, I've repackaged it and say, where would you like to take this mortgage? And they said, well, we'd like to go to the same bank that they were with. No problem. Send it to the same bank, and all of a sudden it's approved, right? So, for example, I'll tell even like banks like Scotiabank. Like I had about 10 Scotiabank employees come to me to get their Scotiabank mortgages, because I'll get better rates and terms than they do as employees of Scotiabank, right? So when it comes to bank versus mortgage broker, and if you got the bank and went a pre-approval, or you got approval, or whatever it is, it's great, it's perfect. But get that second opinion. Go to a mortgage broker and make sure that they look at, your situation, and make sure that you have the best scenario. Many times I'm getting calls, people that have mortgages coming up for renewal, saying, listen, I just got this renewal notice, here's what they're offering. And many times I will tell them that particular, because of where their timing is, you need to take that term that they're offering, because that's the best thing for you at this particular time. So when you're connected to a good mortgage broker, they're always going to give you the right advice, because they want you to put their trust in them, and understand that their role is to help you succeed in your real estate goals, right? And at the end of the day, our business is built, Nicole's business is built on relationships. It's built on referral. And that's why you need, what you're doing really is you're creating your team. You're creating your team from your realtor, your financing, and everything else. So that's kind of where that's at. Yeah. So basically, we talk about choice, experience, the follow up, the advice, accessibility too. So that's the other thing too. When it's 5 p.m. and you got an offer on the table, and you need to adjust it. Um, not probably that bank employee is probably not going to be there to answer your phone call. Right. And this is just an example. Like we just pull up a chart, and it will re-rank depending on what everybody is looking for. It'll re-rank every single lender that's out there. And you'll find that what happens is there's so many lenders that are there. Here you see lenders like Alterna, Manulife, and B2B Bank. And if you'd scroll and scroll and scroll, you'd see the TDs and whatever, because their rates are usually higher than a lot of these other lenders. Okay, so you got to keep that. It's just to kind of just give you a visual of something that we have access to. So let's talk about getting into a home. So one of the big challenges we have, okay, so let's say, for example, you're working, you're employed, you got income coming in, but one of the biggest challenges we have is down payment. Okay, so I'm ready to buy a home. I'd buy a home tomorrow. I'm paying rent. I'd rather be paying my own mortgage. So where can down payment come from? So some of the standard areas that you're looking at is there things like your savings. Okay, anything that you're saving. From TFSA accounts or whatever it is, regular savings, and also RSPs. Some people will invest in RSPs to get a deduction, and then you can use a portion of your RSPs towards down payment if you're a first-time home buyer. But a lot of people lean outside too. So you got family members that could potentially give you a gift to help you with the down payment. Okay. You also have I see a lot more now. You get a lot of, maybe elderly or, grandparents, things like that, their mortgage is paid off. They want to help, right? Their kids or their grandkids. Um, and they don't want to have to sell and move to do it, to sell their house and say, okay, here's some money for down payment. And some of them are doing it, not knowing there's other ways to do this, which is unfortunate. Um, And the other thing too, at that age, they don't want to take on a debt where all of a sudden now have to they make payments every month. So a lot of them are doing reverse mortgages where you don't have to make a payment. You get you access equity from the home. It's tax free. And then they're using whatever portion that they're getting from their reverse mortgage to help their kids or grandkids for down payment as well. Okay, so that's it's becoming more and more popular. Now, and the other thing is there's also government programs. So there's government programs if you're purchasing for any property that's less than $1 million, and they will, if you put 5% down, they will give you 5% on top of it. Okay. Or if it's a new build, they'll give you 10%. Right. But understand that there's also some restrictions on that one too. So for example, sure, they're going to give you 5% to match your 5%. So now you have 10%. So you have more down, but there's also a restriction on the amount of mortgage. It can't be more than, if it's in GTA, it can't be more than 4.5 times the income. So what I find with that particular program, because of where pricing is in the GTA, not many people are qualifying for that particular program. It works more on the outskirts and other areas of maybe Ontario, or it's a Canada program, Canadian program, so it works all over Canada. But I've only done one over the 5 or 6 years it's been out, so not very much, not very many of those. And just to recap on how much of a down payment do I need to purchase? Well, if you're purchasing anything that is under 500,000, you need 5%. Okay, so 5% of the first 500,000. Anything from 500,000 to 600,000, I would need 5% of the first 500,000 of that, and the portion over that, I would need 10% of that portion. So if I'm buying something for 600,000, okay, I would need 35,000 in total. So 5% of the 500,000, then 100,000 remaining. I think 10% of that is 35,000. Okay. So that's kind of the criteria for the minimum down payment. And anytime I'm buying anything over $1 million, you always need a 20% down payment. Okay. So let's go to the next slide here. So let's talk about this new program. So this new program was introduced probably over a year and a half ago. And where the challenge was for a lot of people is if they had less than a 5% down, less than a 20% down payment, um, there's restrictions, because what happens if I have a 20% or less than a 20% down payment, those mortgages are insured. They're insured through companies called CMHC or Sagan or Canada Guarantee. And there's an insurance premium that's added onto the mortgage that's paid by the bank and added onto the mortgage. Okay. And with that, those premiums can be quite high, right? So when the other restriction on that is your maximum amortization, which is the amount of time you pay off that mortgage, is 25 years. Okay. So based on that, you're going to qualify for a certain amount. Now, when you have a 20% down payment, things change. Okay. So 20%, you eliminate that insurance premium, which could be, 15, 20, 25,000 gone. So you've just saved a whole bunch of money by having a 20% down payment. Okay. The next thing is, because you have a 20% down payment, you can increase the amortization or the amount of time your mortgage is paid off from 25 years to 30 years. Okay. So it will elevate how much you qualify for. So this program, which is called shared equity financing, which I'm going to describe, is a new program that it closes the gap, gives you what you need to have a full 20% down payment. Okay. Of which you need to have at least 5%. Okay. And so before I get to the next slide, just to kind of, I'll show you the numbers and the differences it makes. Then I'll get into the program, how it works. It is for owner occupied homes only. Okay. So if it has to be basically a principal residence. Okay. All right. So if we get to the next slide, I'm going to show you here. So based on what I've done is I've created on the very left-hand side is household income. So basically what I've done is I said, okay, here's your household income. And I scale it from 100,000, 130, and went up from there. Okay. Then 2 columns over, I said, based on if I have less than 20% down, what is my minimum down payment based on the maximum purchase price I could qualify for. So on 100,000 income, and if I have less than 20% down, my maximum purchase price is 360,000. Okay. My minimum down payment for that would be 18,000. And then I went up. So if I go up, if let's say I had a total household income of 200,000, now, and my maximum purchase price, if I have less than 20% down, is 820,000. Okay. So what happens when I have a 20% down payment? Same income level. If I go to 100,000, if I compare it to the 360,000 that I would have had if I had less than 20%, that jumps now up to 550,000. Okay. And as I go into, say, down into the 200,000 combined income, I go from 820,000 if I had less than 20% to 1.1 million. Okay. So there's a significant difference in terms of how much purchasing power you have when you have a 20% down payment. Okay. Now, with this particular program with shared equity, of that 20% I mentioned, I only have to have a minimum of 5%. I can put as much as I want up to 15%, but the minimum I have to have is 5%. So let's say I'm buying $1.1 million. My minimum purchase or my minimum down payment is 55,000. Okay. So let's look at a couple family scenarios. So I got family number one. They wanted to buy their first condo. Okay, so they had a combined salary of about 85,000, saved up $40,000, and the maximum they would have qualified for a purchase price for that condo was about 400,000. So it wasn't, they needed something bigger. Okay. Anyway, so with this particular program, that gave them the full 20%, they went from 400,000 to 570,000. Okay. And they were able to purchase. Family number two, they made really good income. So no issues with mortgages whatsoever. But this scenario was interesting because this is a common scenario that you have out there. You have a family that qualifies for a high mortgage, but their challenge is down payment. Okay. So they were renting a home for $3,700 a month. Okay. They, because of where the kids' school and everything else, they had to remain in the same area, and they had three kids, and they were trying to find a four-bedroom home in the GTA in the area that they're looking in for well, anyway, they couldn't find one under $1 million, and they had $100,000 saved. But if, again, I'll just remind everybody, if you're buying a property over $1 million, you need a 20% down payment. So $1 million, they would need at least $200,000 saved. Okay. So spending $3,700 a month in rent, even if they were to double that for savings and, really, really stretched, tighten their belts and really stretched, what they would do, it would have took them at least 5 more years to save up maybe another 100,000. But that price of that home would also be increasing. Like Nicole, you said close to 7% per year. So like $1 million home in 5 years from now is now 1.4 million, right? So it's already increased by 400,000. So my down payment required also increases everything else. So they're always chasing the price, chasing the price. So they're able to use this program, qualify and purchase at 1,150,000. Okay. And the option is here, again, we would look if there's options. They have gift money and from family, but not everybody has that. And if you're not in that situation, and as I want you to think about how this program could work for you or somebody that the situation is that if your choice is to buy now using a shared equity financing program, or wait 5 years and buy after you saved, you're going to find that you're way better off if you can get into a home now. Okay, and I'm going to show you why. Okay, so if we get to the next slide. Okay, so let's look at this. So if I was to, so Arboro is the company that actually provides the down payment. You're doing your financing. We have a couple lenders that we work with to do the financing on this. So it's a regular mortgage that you're going to have. But let's look at this. Let's say I want to buy $1 million property. Okay, and if I wanted to buy it now on my own, I would need $200,000 down, and then it would have an $800,000 mortgage. If I didn't have my $200,000 down now, but I had 50,000, okay, and I qualified for the $800,000 mortgage, I can still buy that $1 million home with Arbor because they'll give the 150,000 that I need to make up the rest of the down payment. Okay. Or if I waited 5 years from now, okay, and it appreciated 7%, I can buy that same home I could have got for $1 million today for 1.4 million. So I would have lost $400,000 of equity already. My minimum down payment that would have been $200,000 today, or 50,000 if I used Arboro, is going to be $280,000 down the road, okay, at the new price point. And my mortgage that I would have got today at 800,000, the mortgage I'll need down the road is 1,122,041. Okay. Huge difference here. Like looking at that same home, waiting and buying, down the road or getting into it now. Okay. So this shared equity financing thing, I need to know what happens when I sell it. How does it work? So let's go to the next slide here. Okay. So what happens here? And I probably should have actually put this slide a little later on. What's the next slide here? Yeah, okay, so let me do, and sorry, just let me see the next slide. Yeah, okay, back up. I'll do it this way. Okay. Okay, so let's do it like this. So let me leave it on here for 1 second, then we're going to go back to the other one. Okay. Um, so there's usually a pie chart thing that I show you and what it means. So for example, when you're buying a home using shared equity, okay, what happens is whatever my down payment I'm putting down converts into an equity share in that property. Okay. So if I put 5% of a down payment, okay, that translates to 25% equity share. If I had 10%, which is 50% of the down payment, it would be a 50% equity share. Okay. So that's kind of how that works. If I put 8%, that would be a 40% equity share. So it always, whatever my down payment portion is, translates to an equity share. Now, what that means is, so if I'm buying $1 million property, okay, and I put down, let's say 80,000, with this scenario, so that means I have a 40% equity share, okay. That means Arbro will come in and put $120,000 down, okay. So that's basically what it is. That makes that 20% down payment. So let's fast forward. What does it mean when I sell it? What do I owe them back? How do I pay them? So basically, you're only going to pay back the proportion of the equity increase or decrease, and I'll explain why decrease in a second, when you're selling the property. Okay, so let's fast forward 5 years from now, and let's say we're selling this property for 1.5 million. Okay, so now it's I'm selling it for 1.5 million. I have a 40% equity share. So that means I'm going to be getting $280,000. Okay. But wait a minute, I've also had a mortgage of 800,000. I've been paying that mortgage on a regular basis. What about all my principal payments that I made? So yes, all the principal payments, I get credit for that too. So let's say after 5 years, I paid off $100,000 of the principal. So now I'm cashing out, I'm walking away with 380,000. Okay. Arbro gets their portion, which is 420. Okay. And some people focus on the 420 and say that's a lot of money, right? But let's back up a bit. Okay. I put in 80,000 5 years ago, and I'm now walking away with 380,000 that I can now go and buy my next home. How did I turn my 80,000 into 380,000? Well, because that 80,000, if I put it into a bank or a GIC at 10%, I would have got 8,000 in 1 year. But instead, I put my 80,000 into $1 million home that appreciated 7% per year. So I'm making way more money on my 80,000 because I'm making it on the entire value of that home. Okay. And that's where the power of investing in real estate and having your money grow through the growth of real estate, because I'm only putting in my initial down payment. I'm leveraging everything else around it. But the value of that home is increasing. So that's where I'm getting that benefit. Okay. So let's look at the middle scenario. Let's say what happens if I buy it for 1 million, market doesn't change 5 years, and I sell it for 1 million. Okay. So I get my 80,000 that I put into it. I would get all my principal payments that I put into it. So I'd walk away with 180,000. Arborough, the company that provides the down payment, they would walk away with their original 120,000. Okay. So the other thing with those, again, now I'm not paying the rent, I'm paying my mortgage. Okay. And the other side of it too, I'm still walking away ahead of money, even though the property didn't increase. Okay. Now let's go worst case scenario. What happens 5 years? I get this question. Well, what happens if the value goes down? Do I owe them money? So let's say we go from $1 million and it goes down to 800,000 when I'm selling it. Okay. So that 200,000 down payment combined with Arboro and what I put in is gone. So because it just decreased from 1 million to 800,000. So I get zero, but I still made all of those principal payments towards that mortgage, right? So let's say I paid 100,000 off the mortgage, I would walk away with 100,000. Okay. Arboro would walk away with zero. Okay. So they share the risk in the increase decrease, but it could never decrease below the equity value of that home, which makes it very, very attractive for any type of buyer because any loss that's sort of I guess brought on by market change is absorbed in part by the Arbro being the partner that's in there. Okay. And hopefully that makes sense. Okay. Now the next just go to the next slide because I want to make sure that's or sorry, go back to the previous slide. Yeah. So there's a calculator. What we do is, okay, listen, so what does this mean? And now I can put in these amounts. What would it mean if I do walk away? If that scenario that I did the first time when I said, okay, that property I'm buying for $1 million appreciates 7%, and after 5 years it's 1.4 million. Okay, so what if I put 50% of the down payment, if I put 100,000? What would I walk away with? So there's actually calculators you can put it in there to say, okay, what would you walk away with? So in this particular instance, with this purchase price of $1 million, where interest rates are right now, appreciation 7%, 5 years from now, it shows you the remaining equity. So basically, I paid $60,000 off. Like the previous sample, I said you paid $100,000 off, but let's say I paid $60,000 off on that mortgage. That principal is returned to me. So the remaining equity is 602,000. Now that gets split. Okay, so basically 50%, 50%, plus I get all my principal payments on top of that. So now I'm walking away with 361,000 after 5 years. My down payment is all ready for my next home. Okay, and my next home, I don't have to do a shared equity financing. I'm going to have that down payment so I can take care of it on my own. Okay, so the down payment or the equity using this particular program, again, it's a program you use if your choice is to wait and save versus get into a home now. And it's also should be used as a stepping stone to get to your next home. It shouldn't be for your forever home. There's no restriction in terms of the amount of timeline. You can keep it for 25 years if you want. But I recommend, 4 or 5 years should be your target. Let the property increase, cash out, go buy the next home, take that equity you just made in that home that you leveraged, and then buy that next home. Okay. Let's head 2 slides down. Next one after this one. So just want to go through a few points on this one. Okay. So with the shared equity financing, there's no restriction in terms of selling. You can sell at any time. Okay. I always get questions. What if I really love this home and I just want to refinance and pay them out? You can do that. They're going to do appraisal at the time you want to do the refinance. They do expect a minimum rate of return of 6%, but as long as it makes that 6%, then you can refinance, pay them out their portion, and then then the home is absolutely not part of the shared equity anymore. Okay. The minimum purchase price is actually 550,000. I have 570 on here. It's actually 550. But more importantly, because often this gets referred to as co-ownership financing, and I don't really like that term because it's like Nicole. I think that co-ownership, you and I are going to own a home together, and you're going to live upstairs. I'll live downstairs. You use the downstairs basement, the bathroom, or whatever. It's like, or we're going to be untitled together. They're not like, so basically there's a beneficiary agreement in the background. So when you sell it, you have to clear out that agreement. but they're not on title. Only you're on title. You can move financing from the one lender to the other lender. It's your home, right? Is basically what it is. There's no liens, there's no loans, no loan payments, anything else. You're just leveraging the down payment, getting into the home, and you're going to be paying them out their portion when you sell the home. Okay,
Mhm.
makes sense. Any questions, Nicole? You're good.
Just one comment. In
Yeah.
addition to all of what Lauren explained, they do want people or homeowners that are co-owners to be very successful with their home. So they do have programs to help you to maintain your home, to help give you advice or suggestions in terms of making sure that you're really keeping the property to the best possible shape as possible. So, you know, when it comes time to sell, you want to maximize the equity gain in your property. So it's not just, you know, providing funds for the down payment assistance program, but it's really also helping you to maximize that equity growth.
Yes, and to your point, so I get a question. I just had this question today too. So what if I want to do some renovations? Like, how does that work, right? So they have a renovation program. So basically, you fill in all the criteria for this renovation program, and then what they'll do is obviously that renovation could enhance the value of that property. And what they'll do at the when you actually make the sale, they'll credit you back the cost of those renovations, right? So you get additional credits above and beyond what your equity split is based on, you know, the investment you put into that property as well. All right,
Any
next
other questions?
next slide. I don't know if I put in the closing cost stuff. Did I put that
You
or?
did. You did.
I did. Okay, so a couple of things to note on this one too. Um, I apologize. I had to find a picture of a house, and the only one I had was one with snow on the lawn. That's not the one we want to see yet, right? So, sorry. Anyway, so a couple of things to keep in mind with this particular program. You're going to be eliminating all the CMHC and insurance. But the other thing too is the land transfer tax. So if I put 10% down, I have a 50% equity share. I'm only going to be paying 50% of the land transfer tax at closing as well. Okay. There are some additional costs in terms of the type of lending and stuff like that too. But overall, when you compare the cost of having a high ratio mortgage and the total land transfer tax and using this one, they're very comparable as far as closing costs go. Good. Important to know the locations, right? So this is it. So it's not available everywhere, but for sure the GTA. So Toronto, York, Durham, Peel, Hamilton, Dufferin, and Simcoe. Okay. And when I see some of these areas like Simcoe, it's got to be in like Barrie and popular areas, things like that. It can't be one of the farms and you know off the beaten track. But also expanded to Hamilton, London, Kitchener, Guelph, Waterloo. Okay, so those are the areas that this particular program you can take advantage of and really this could make a difference. This is a difference maker for a lot of people in getting to a home sooner.
Mhm. So,
Yeah.
all right. We are just about at time. And I know we wanted to really review the down payment assistance program. Do we have any questions? I want to go to questions and then I can just quickly review the buying process. And you feel free to just chat them in the chat box or use a emoji to say, keep going. Okay, I'm going to keep going. All right. So in terms of the buying process, very quickly, making sure that you have a real estate agent, someone who you can trust, you can work with, who provides you with a nice overview, explains the process to you, and really listens to what you need, what you want, and really partners with you to create a team that will help you achieve your goal. So in addition to that, knowing your numbers. So Lauren really provided a nice overview in terms of the financials from a down payment perspective. So really understanding what you can afford before you go out and look at any properties. understand what you can afford, having a pre-approval. And a pre-approval is not, yes, that's the amount I can definitely purchase, because once you get into the actual process, the financial institution will make their appropriate determinations. But have a really strong understanding, working with a mortgage broker, mortgage specialist to understand your numbers. Once that's in place, this is when you come up with your strategy, working with your realtor, your mortgage broker, mortgage specialist, a lawyer, home inspector, the appropriate individuals that you need to be helping you to make the appropriate decision. So having that strategy, knowing what you need. So really focusing on your needs with regards to the property that you're looking for. In terms of viewing homes, that's the next step. Once we clarify, we know the price, we know the area, we know what you can afford, your timelines, going out and viewing homes. And having ongoing communication is really critical. So when we're viewing homes, it's not about necessarily, yes, we want to find the right one, but it's almost a process of elimination, in the sense that you want to eliminate the ones that you don't want, so you can really focus in on, yes, this is what we're really looking for and what we want to get. So two-way communication, yourselves, the buyer, and the real estate agent, and other members of the team. Once you've found that property that you want to put an offer on, this is where you're working with your realtor, you're working with your mortgage broker, you're working with your lawyer in order to ensure that your sale is structured appropriately and that your realtor can negotiate on your behalf. Then once the offer is accepted, we manage the transaction in terms of getting the financing finalized and approved, having the appraiser come in if needed for financing, having the home inspector come in and take a look at the property, doing the title search with the lawyer would be processing. So all those kinds of things, making sure that you're managing the transaction, the conditions, all the other items that come after the agreement is finalized. And then what Lauren and myself like to do is really, we like to work by referral, really taking care of our clients, making sure that we have your needs. We can assist you in any questions you may have, or if you have someone who's looking to purchase or sell real estate, we would love to take care of you. So that's that check-in. Right. And then one of the key things for this year in terms of real estate I was focusing on is making sure that you know more. So these educational sessions are put together so you know more, that you can be more confident. So if you know more, you understand the process, you're more prepared, and then you can be more confident as you get into the process. So I typically have a planning calendar that I work with my clients, and a mortgage professional that you can work backwards for. When are your targets? What date are you looking at? And then work backwards to see how can we meet these timelines. And then it's always important to continue to learn more. I actually started a podcast this year, and there's some great sessions on there. They go from 20 to 40 minutes. So if you want to learn more about real estate investing, feel free to go ahead and scan here. And I also included in my newsletter. But you can scan and listen to it. If you like something, please feel free to rate it, write a review, and share it with somebody else to help them to learn more. And with that, I'm just opening up for any questions you may have. All right. And just wanted to say satisfied clients. So thank you, everyone.
That's awesome, Nicole. As always, you are so good. And Yeah, and your clients are blessed to be working with you because I know you take care of them not just from the point where you meet them, but all the way through to the time when they're mortgage free and have financial peace of mind. So they're very lucky to have you.
Thank you, Lord. Thank you. Thanks, everyone.
Thanks so much.
Have a great evening. And thank you, Lauren, for amazing presentation and explaining that shared equity program. I think it's going to be helpful. So if you know anyone who could benefit from this program, please feel free to reach out to myself and I can put you in contact with Lauren.
Perfect.
All right.
Thanks, Nicole.
Okay. Have a good evening, everyone.